Hello, I'm Alex Davies, founder of Wealth Club. Today I'm with Louise Farley of Deepbridge Capital to talk about their technology growth and life sciences EIS. Hello, Louise.
Hi.
First off, tell me about Deepbridge, who they are, and sort of give me some background about your own experience.
Yeah, so Deepbridge was founded in 2010, so we had our 10th anniversary this July. We're very much sector VC, sort of venture capital sector specialists. By that we focus on three core areas, being technology, life sciences and renewable energy. So we're about 170 million funds under management right now, of which about 100 million of that is invested across our two EIS funds that we're going to be talking about today. We've got head offices in Chester. We've also got presence throughout the UK, and we also have an office in Australia, and we're a team of about 45 people now. My background, so I've been in financial services for nearly 20 years. I started off my career in 2001 working for a financial advisory firm. A couple of years after that, I then co-founded a fintech software business, which later sold to Mortgage Brain. Got into the private equity world in 2005, so I've worked in-house at companies that were involved with VCTs, EIS and also inheritance tax services. So that's both in the retail side with unquoted investments and also with quoted investments. Then in 2011, I set up my own consultancy firm where I've worked with a number of the companies in the tax efficient space. That is alongside some institutions and family offices, along with some SMEs also. So I have experience on both the company side and also on the fund side. And actually Deepbridge were a client of ours, so I actually merged the business and ported my team across it was just over 5 years ago now. So I've been working with Deepbridge for about 7 years, and I've never looked back since.
And so tell me about the two funds.
So we're talking about the Technology Growth EIS Fund. So that was established in 2013. There is just over, I think it's about 31 companies in that now, and that's at about 75 million under management, and that's funds that have actually been deployed into companies there. The Life Sciences EIS was established a little later in 2017. That's also spread across about 30 companies, and there's about 25 million in those funds.
Typically, each investor, how many investments would they have in their portfolio?
Typical investment size is around sort of 4 to 7 companies. The average size of our investment is about 33 million, but the actual minimum size of the investment is 10K.
So what are the characteristics you're looking for when you invest in a company?
We're looking for companies to be IP driven. We do like patents, but they're not essential in what we do. We're looking for companies that can either significantly disrupt an existing market or create a completely new one. In terms of the management team, they have to have a deep understanding of the sectors that they're operating in. They have to be globally scalable. They also have to have the opportunity to operate in multiple verticals. But of course, the stage that we're investing in, you hear a lot about companies talking about how they should be revenue generating or very close to being so. We tend to come in a little bit earlier than that, so it will be where the technologies might have gone through the R&D stage, that point of commercialization. There's certainly visibility on the signing of some significant contracts, etc. And again, on the IP side, certainly with the life sciences sectors, it's not always essential that it's going to be revenue generation, which is going to be what's key to creating capital growth. It can be that value of the IP in its own right.
And where do you get these deals from?
So we have a very strong proprietary deal flow. This has come from our own sector experience, also from years of seeking new investments from tech transfer offices, universities, incubators. We also look across territories, so we will seek out trends. For example, right now we're seeing a lot of interesting stuff in the femtech space, lots of stuff going on around menopause, also mental health. Sort of just coming back to territories, obviously we talk about the US and what used to be Silicon Valley, which then turned into Silicon Forest. There's a lot of interesting stuff going on in Israel at the moment with Silicon Wadi out there. And of course, we've got our office in Australia, where we've been seeing very strong deal flow for a number of years. So we continue to be very interested in what's happening over there.
So other than the money, what do you add to these businesses? Why do they come to you for investment?
We are ultimately a team of business builders. So we're not interested in just investing cash into a business. It has to be where we can lend our own skill set. Being sector specialists, this is very much an attraction for companies to come to us because they do expect to be able to get, first-rate additions to their companies. So we will help to bolster the team. We also help with strategy. There's what's sometimes interesting is some synergies within our own portfolios. Right now within the tech growth portfolio, there's two companies, Chainvine, which is a blockchain business. We've also got Chameleon, which is like an invisible sort of fingerprint. Both companies are operating across the steel sectors and also wine. Would you believe there's such a thing as counterfeit wine? But what these companies are doing, sort of being brought together, is that Chameleon can actually put this invisible fingerprint on the product, such as wine or steel. And then what Chainvine does is, through its ledger system and technology, is actually track the journey of where that's going. So it's helping to stop sort of counterfeit wine and counterfeit steel.
Can you talk about some of the investments you've made in the Deepbridge EIS?
Yeah, it's quite interesting. So as I said earlier, like the tech growth EIS was established in 2013. So we're starting to see maturities happen within that portfolio and some exits. Some really interesting ones that have happened over the time, I'd say Voxmart. Voxmart is a company we invested in about 4 years ago. It's involved in mobile surveillance and compliance technology. Of course, what's happened in recent months with the COVID pandemic, everybody's had to start working from home. This has been great news for Voxmart because it's meant that everybody is now using their mobile phones, and of course industries and financial services, etc. They've had to ensure that they can do so in a compliant manner. So as a result of which, the company is now attracting significant interest, not just from new customers, but also from co-investors and hopefully some potential exit opportunities. Alongside also on the life sciences side, we've got Elasmagen. And Elasmagen is a sort of proper bio pharmaceuticology R&D business. So what I was saying earlier about the value will not necessarily always be in the revenue generation from the outset. By the very nature of medical companies, they can take a bit longer to sort of go through the various licensing, etc., that they have to do. But with Elasmagen, they likewise with COVID, they've received one of the COVID continuity grants. So they are now being, funded to explore their technologies and helping with the sort of COVID oncology side of things, and alongside which they're also now starting to get significant interest, which will start building up revenues in the business.
You mentioned exits. Can you talk to me about some of the exits you've had?
Yeah, so we had a full exit from our tech growth portfolio last August. This was in a company called iPipeline. This was involved with life insurance software. It actually sold to a Florida tech business for $1.6 billion. I wish I could say we had a big chunk of that, but we had a very small piece, but that still represented a return to investors of about 3 times on their investment. And then likewise in Sky Medical, so we had a partial exit in October 2017. I want to say a partial exit, so the actual sort of history behind that is that it's a medtech business, and one of its Canadian distributors loved the product so much, they wanted to buy out any existing shareholders at the current share price. So we had investors come in at 36p in the early days. This offer was on the table at £1.85. So we had some investors looking at nearly a 5 times return at that point. Investors didn't fully exit the company. The value of those shares are valued today at £3. And now where we are in the investment cycle, we know we're starting to look for a full exit on that one.
And how's the pandemic been for you?
Oh, 2020, what a year. Not only have you had the pandemic, you really had the B, C and D words being the Brexit, COVID and of course Donald Trump. But just looking at the COVID situation, given the fact that we do operate in technology and life sciences sectors, to some degree, every company has had to adopt tech in some way. So you could, argue that the companies in our portfolio has been relatively sort of insulated to that degree. A lot of companies, they've been quite inventive with some of their strategies. You've seen some pivoting in some of the business strategies to take full advantage of what's been going on in the world. And a lot of them have actually been able to preserve cash also. So a lot of the companies have actually benefited from COVID and the pandemic. So they're really stepping up to the opportunity that's being presented here.
Any companies doing particularly well as a result?
Yeah, actually, we've got a company called Hurricane, which is a company in the e-commerce software space. And you look at the fact right now that governments are trying to recoup debts to fund what they've been doing to support the economy, and actually. Hurricane operate in the duties and taxes side of things. So I'm not sure about yourself, Alex, but certainly during lockdown, I've been spending a lot more on my online shopping. So Hurricane's really taken advantage of that and is helping get those important duties and tax income back into the economy.
Very good. And how risky is it investing in EIS?
I mean, ultimately, we are talking about early stage businesses, so they are inherently going to have higher degree of risk. The beauty, of course, with EIS is that the government recognises this, so you've got the tax reliefs alongside. We at Deepbridge would like to think that we look to mitigate the risks of investing by being sector specialists. We very much know our onions. So the type of companies that we're backing them not only in the short term. The length of time with the investments, we're almost getting wedded to a business for sort of 4 to 7 years. So we want to be, very sure through our investment criteria that we know what we're getting into. So we do look like with our hands-on management side of things. We hope that working with the companies, monthly KPIs will put people on the board to ensure that we can actually infer some change if need be.
And do you expect many failures in the EIS fund? And have you had many failures?
It would be naive of me to say that we don't expect any failures. Right now where we sit, we haven't actually got any within the EIS portfolios. We operate SEIS alongside, you'd see some wobbles there. But within the EIS portfolios, we operate a evergreen deployment strategy. So some people often say to me, well, why? What's the benefit of doing that? Of course, to the investors, there's a higher visibility on companies, and they're refreshed monthly, so they can see that. To the companies, by deploying sort of capital over a few months, they might be in a certain tranche size. If you take the analogy of like cash and fire, if you give the company sort of too much, it will burn and sort of burn up. But if you don't give them enough, they'll go out. But you have to have this sort of constant drip feed of cash, and that just gives us a bit more control of being a hands-on manager to ensure that they're doing what they should be with the capital.
And finally, if I want to put money into EIS this year, why should I choose Deepbridge?
I'm obviously very biased, so Deepbridge is a fantastic choice. By operating in the technology and life sciences sectors, one of the things that's come out from the pandemic is you're looking at all the sort of pundits and the market trends who are all saying, digital transformation and healthcare innovation is the winning sectors to come out of all this. This is something we've always done. We've been operating in the sector as Deepbridge for 10 years. So by putting your cash with us, you've got the reassurance that you are actually coming in to sector specialists, hands-on management. So we actually know what we're doing. To investors, again, another benefit is of transparency. So this isn't just from ongoing with our reporting, it's right from the outset. I mentioned earlier that we do these monthly deployments. We're very transparent on the companies that they're going into. So investors can actually ask us, well, what type of companies, if I was to invest tomorrow, is my money likely to be put to work to? And we can actually give that information over. Not only that, obviously there's the added benefit of the speed of deployment, that we do monthly deployments. So from a paperwork side of things, that's a quicker turnaround on the EIS3 tax certificates. And so, just right now, given where we are in the world, there is a bit of a sort of emotive sentiment as well about investing, certainly in technology and life sciences, and people do want to see that their money is doing some good. So, we're not investing in biscuits, we're investing in companies that, very much have a genuine offering to support, companies with a genuine need that's going on at the moment.
Louise Farley of Deepbridge Capital, thank you very much.
Thank you.